Hey, we were getting together this week to record our regular Ask Adam Anything video, but you did a great interview with Strategic Fortunes editor Ian King that does a really, really good job answering a reader question we got about the craziness we've experienced with the market this year. So I think it works perfectly for this week's Ask Adam Anything segment. Now, if you're watching, don't forget to reserve your seat to Adam's urgent November 4th briefing, where he's going to tell you about this little-known perfect trading window that's about to open up. And it's a strategy that he's developed to exploit this perfect trading window, and it's already crushing the market by 6 times. So you don't want to miss out. Now, I'm going to join next week for another episode of Ask Adam Anything. But in the meantime, if you do have a question about the market or anything else you'd like to ask Adam, do so by emailing us at feedback@moneyandmarkets.com.
Hey everyone, Ian King here with your Winning Investor Daily weekly YouTube video. We've got a special chat this week. I am going to be talking to my colleague, fellow editor, Adam O'Dell, and we're going to get into what has been going on in the last year with all these different manias we're seeing, whether it be the GameStop stocks or different cryptocurrencies, the meme coins. So I'm excited to have this conversation. But before we get into it, I just want to remind you, if you haven't subscribed to our channel yet, please hit the subscribe button. If you like what we have to say, smash that like button. And always feel free to leave comments. We'll be sure to adjust them on a future update. Adam, why don't you tell us a little about yourself? How did you wind up here at Banyan Hill? I know you joined just a couple of years ago. Give the viewers a little bit more about your background.
Yeah, sure. Well, first of all, thanks so much for having me on, Ian. I've been trading the markets myself for over 15 years now. I used to run a hedge fund for institutional clients where I ran a diversified trend following model across all 4 major asset classes: stocks, bonds, commodities, and currencies. But I got a little disillusioned with the institutional trading world. And I really saw a lot of regular folks that were nearing retirement, trying to play catch up and not really making it with the 60-40 portfolio. So I was looking for some innovative ways to bring my ideas and strategies to the market and to regular folks like my parents that worked hard and were just trying to catch up on retirement. And so really when I found this business model where we can reach individual retail investors all over the world that want to take the bull by the horn, so to speak, and take matters into their own hands. That's really when I found my groove. So I've been doing this for 10 years now, and I absolutely love it.
Adam, I can't agree with you more. It sounds like our principles are exactly aligned. And also, it sounds like we also come from similar backgrounds as well. But let's talk about the last year. And, you've been a trader for over a decade. Myself, I've been in the markets. I don't want to even mention how old I am. But this has been one of those years, I think, that you see once in a decade. And, give our viewers, an example of just the craziness, the lunacy we've seen this year from your perspective.
Yeah, absolutely. I mean, I'm a trend follower and a momentum trader. Price is king to me. So I'm much more on looking at the price action and developing models that model that price action than anything else. So I'm also one to not fight the Fed. So I've been bullish, ever since 2011, really. And that's run counter to a lot of the narratives, but stocks have climbed that so-called wall of worry. But really in this past year, I'm starting to see opportunities that I haven't seen in my entire career. And I'm really excited for the next 12 months because I think a lot of people thought that the retail participation that began, kind of the late 2020 when folks were stuck at home. I mean, you've heard the narrative yourself, Ian. People are stuck at home with nothing to do. They're getting stimulus checks. They're going to put a little bit of money in the market and they're going to blow it up and go away. But I think that people are underestimating the durability of this retail crowd. It's not going to last forever, but I think that the best 12 to 15 month period is actually ahead of us rather than behind us. I don't actually try to follow the meme stocks. I think that they're a bit too volatile, and with the way we work with our subscribers, that's not really what I do. But just as one example, you asked for an example in my flagship service, Green Zone Fortunes. We recommended National Beverage Company, ticker symbol Fizz, F-I-Z-Z. They make LaCroix flavored water.
Our family drinks LaCroix, by the way.
Yeah, I mean, they're big with millennials and everybody. So certainly people are trying to drink and eat healthier.
Is it LaCroix or LaCroix? I mean, do we use the French?
Yeah, I've heard it a couple different ways. So,
okay.
I'm probably saying it wrong, but nonetheless, I mean, that was basically a very similar move to the GameStop move, where there was a ton of short interest in that stock. If I remember right, it was about 34 days worth of short covering, short interest in that stock. And we recommended it to our readers in mid December. And we got a parabolic move within like 3 to 4 weeks, and we're able to take gains of over 100%. So that's just, one of those types of, when I see moves like this, I know that we're in a retail driven market. And that's one of the, frustrating things about just investing in the S&P 500 as a whole. It's so dominated by institutional trading. You get a lot of mean reversion. You really don't get those, blast off trends that you would get in a more infantile market or in a retail driven market. So that's really why I'm excited for the next 12 months, that the retail crowd is here to stay. I'm following Interactive Brokers. That's one of our portfolio holdings. And every single monthly and quarterly report they come out with, their daily active revenue trades, their new accounts, their account equity is just growing like gangbusters. And again, it won't last forever, but the next 12 months, I think, is going to be ripe.
Sure. And, I wrote about something like this similar, last year during the depths of the coronavirus sell-off. And I really thought that the mother of all bubbles was ahead of us. Mm-hmm. And, bubbles doesn't have to be derogatory. I mean, you just have to know how to play the game. You have to be an active trader. You have to be able to get in, get out. What's interesting, though, is like, it's not like everything's inflating all at once, right? So one month you might have kind of these like zany stocks that have no earnings go up. The next month it might be electric vehicles. The next month it might be cryptocurrencies. And it seems like there's just hot money retail traders that are just moving from one trend or one hot sector to the next. And, I really agree with what you said, is that you have to be able to ride that momentum. You have to find that momentum. You have to get in there before other traders are, and you have to sort of find that catalyst, which is why I love that trade in Fizz. You see something with high short interest like that, and that those hedge fund traders, for the most part, are just going to get squeezed. And this has been a year where you just throw fundamentals out the window, right? I mean,
absolutely. And you said something important. You said, jumping from one hot sector to the next, and it is not all at once. And really, I've been running this service for 10 years now, Home Run Profits, where it was based on sector rotation. It was based on this idea that each of the 9 major sectors of the U.S. economy go through periods of underperformance and outperformance. And if you can time the period of outperformance, even if it's just a 2 to 3 month window, which is our typical holding period in that service, if you can time that correctly, you can basically jump from one market beating sector to the next. I mean, obviously tech stocks have gotten a lot of press in the past several years, obviously meme stocks in the past year. But I mean, we also saw industrials and materials companies go gangbusters in the last 6 months. So it's not just tech stocks that we're targeting for this. I'm agnostic to sector. I'm agnostic to what type of technology is underlying the company. I'm basically a price action guy. I'm all about momentum. My goal is to figure out when a stock has reached this point of maximum momentum, and then I try to get into that trade for 2 to 3 months at a time, take my wins, try not to be greedy, and then get out and move on to something else.
Yeah, I love it. So, a specific question, I guess a lot of viewers are probably like, well, aren't markets efficient? I mean, if you're able to exploit this, like, are you proving the efficient market hypothesis wrong here? Efficient market theory wrong?
Right. Well, I mean, that comes from Fama in French, and Fama already admitted himself that momentum was the biggest embarrassment of his career. And that was in like 96. So yeah, I mean, it's markets are very often efficient on the aggregate level. I think they're mostly efficient, but that does not mean that there are not pockets of inefficiencies. There are absolutely pockets of inefficiency. And I mean, all you have to look at is the price action of stocks like GameStop and AMC and Hertz, even Tesla. I mean, I know you get people on both sides of Tesla, but I mean, if you look at the price action in Tesla, it can't necessarily be explained by fundamentals alone. Right. I remember speaking at an investment conference in 2019, and somebody did this, real fundamental analysis of the debt load and how Tesla would never be able to pay back their bondholders. And I mean, but if you look at how much they've been able to raise capital in secondary market offerings since then, I mean, it's clearly not a fundamentals driven market, as you said.
No, I believe the market's driven much more by the narrative. And also to your point on efficient markets, it's like if markets are efficient, you wouldn't have these quantitative funds that have just outperformed the market for so long.
Absolutely.
You look at like the returns of Renaissance Capital, which I think since like 1985 has made something like 60 or 80% a year, just because they work with more data and have smarter, quants than everybody else.
Right.
But If our viewers want to learn more about the strategy, tell us, exactly how they can follow you, or do you have an upcoming webinar or something that they can join?
Yeah, I mean, I'm actually put together a webinar November 4th about this specific period of time in the market. As I've mentioned, there's been a lot of doubters the whole entire bull market. And if anything, I think that's just added kindling to this fire that we're about to experience. And a lot of retail traders came in during the pandemic, and a lot of people were doubting them. But now I think that the people that have been left out are starting to look at this market, make higher highs and higher new all-time highs. And
right.
Everybody thinks that, the way you get rich is to buy low and sell high. So they've waited for this next crash, and they've been waiting year after year. I'm all about buying high and selling higher. Last time we talked, you talked about if you feel like we're in a bubble, then start buying with both fists.
Exactly.
That's a Soros quote. And I'm all for finding a window of opportunity and exploiting it in a safe way. But it's all about convexity. If you can risk $1, so to speak, and to gain $4 or $5 or $6 or $10, that's a trade you should make every day, because your hit rate doesn't have to be 50 or 80%. It can be, you can get 1 out of 5 trades right and still make a lot of money. So I think this next window of opportunity in the next 12 to 15 months is going to be gangbusters. And I'm just trying to get the message out. I know that a lot of folks are on the sidelines, so I'm trying to bring people in that want to be in this market, but that aren't exactly sure how. I have a system that I've used for over 10 years now to do exactly what this market is presenting to us. So.
No, that's exciting stuff. So I'll make sure that we link to your webinar below this video, so anyone that wants to view it or sign up for November 4th. What time again?
November 4th. I'll have to check with my team. It's probably 4 p.m., but we'll include, I'll get you that information.
So if they just sign up for the link, they'll just get it, put their
Absolutely. Yeah. We have some information that we'll drip out to folks that sign up. You want to get your name on the list, and we'll give you some extra information leading up to the event. I want to make sure everybody's educated about this opportunity, so that when they're ready to trade, they're ready to go. So.
Yeah, I'm on board with that. One stat that I follow is some crazy statistic I think the Wall Street Journal published back in March of 2020. Oh my God, what year is this? Yeah, right in the depths of the coronavirus, March 2020. It feels like every day.
It's been a long one, right?
Working from home is like every day is the same. It was like in the middle of the coronavirus. It said something like 60% of individuals 65 and older like sold all their stocks right at the bottom. It was some crazy stat like that. And I just thought at the time, like, the same investors are just going to start FOMOing back into the market as we go higher, and that's just going to lead to more and more momentum. And then the backdrop that we still have, which is going to be consistent, the macro backdrop, is the Fed is going to leave the punch bowl out for longer. You're worried about inflation. The Fed's okay with higher inflation. They said they want higher inflation. We haven't had inflation in 15 years. So that's like another impetus for the market and the momentum to keep going, is that we've got $8 trillion of capital flushing around, this market that's not going anywhere, or it has to go somewhere.
Right.
So I love that idea of being more active in stocks that have lots of momentum in the short, medium type term trade, 2 to 3 months for the next year or so.
Well, that's the thing. Ever since 2011, there have been doubters about the bull market. There have been reasons to point to underlying weaknesses in the global macro economy picture. So I made a decision in 2011. I made 2 decisions. First of all, don't fight the Fed. If the Fed is behind us, and if the trend is higher, go with the trend. Second of all, I made the decision to show everyday retail investor folks a way to make short-term gains. This isn't day trading. I'm not expecting anyone to be on their screens for all trading day. But if you can make bets over a 2 to 3 month period of time, then if the market starts to turn over and reverse and roll over, then you can get out of that batch of trades and reevaluate without too much harm. You can't do that with buy and hold. If you're staking your whole retirement on 60-40, then you basically have to hope that you don't get another 50% drawdown. But that's why, medium term trading over 2 to 3 months period of time, I think, is a much safer way to go than buy and hold. And I'm just trying to get the message out for as many people as possible.
Yeah. And I'll say, this year has been a great year for sector rotation. We started with the tech stocks earlier this year, then it rotated into energy stocks, and then you had the reopening stocks, the airlines and hotels. And then the last couple of months, the bank stocks have been in play again. So it's definitely been one of those years where, if you had an actively traded system where you're moving from one sector to another, you really would have outperformed the indexes. So,
and every single sector you just mentioned, we've made plays on. We got into a trucking company toward the end of 2020. We got into a small regional bank at the end of 2020. We got into energy stocks earlier this year, and then got out of them as they went sideways. We're in consumer discretionary stocks right now. You see Tesla, making new all-time highs. Elon Musk is now the richest man in the world. So we certainly got a boost of about 140% off of that trend. So yeah,
no GameStop though, right? No GameStop, no AMC.
The thing with those is, if you're not on Reddit and if you're not early and you're not part of the colluding crowd, I don't want to bring my subscribers late to something that's going to fizzle too quickly. So the thing is, you don't have to, in my opinion, you don't have to play those stocks. You can play, the retail crowd is in the market. So if you can find momentum plays that aren't the most popular ones, I think the gains are just as good with less risk.
Oh, and it's also the risk. I mean, GameStop, there was a 1 week period where it went down something like 60%,
Yeah, absolutely.
You save those that volatility for your cryptocurrency portfolio, not for your stock portfolio.
Yeah, at least the upside's worth it in the crypto market.
Yeah. Let's, we're going to link to your email list below. So please click the link, sign up for Adam's list. Adam, thank you so much for joining us this week. I'm actually going to tune into your webinar on November 4th, so I'm going to sign up as well. And thanks everyone for tuning in this week, and we'll talk to you next week. Take care.
Thanks, Ian.